to support the Cook County financial response to the COVID-19 pandemic, and
We're waiting for two more.
Wanted to introduce my colleagues. Natalie and Monica will be covering revenue replacement today under the American Rescue Plan Fiscal Recovery Fund. And before we get started, want to just thank Cook County and turn it over to Michael and Bolo for some opening words.
Thank you. Good morning, guys. What is it? Happy Thursday today. Michael Ambolo, Deputy CFO for Cook County. We are delighted to host this call today, and we hope that you get a lot out of it. We're going to be going over some specific topics today that everybody's been kind of chomping at the bit for, and we hope you find it engaging. Please use the chat feature for any questions that you may have. Do the little raise your hand thingy on the top, and if you can't, just go ahead and shout it out, and we'll do our best to answer all those questions for you. If we have any caller cardings on, welcome to the call, and please don't be shy, guys. Everyone on the call, please ask your questions. That's what these are for. Take it away, Guidehouse.
Thanks, Michael. Thanks, Trina. So we're going to do, I'm Natalie. I will be leading today's webinar on the revenue recovery calculation. So just give a little bit of quick background on ARPA, or the American Rescue Plan Act, that President Biden signed into action earlier this year. There's 362 billion rather that was directly associated with state and local governments, and of that, Cook County got about $1 billion. And I know a number of you have received money either directly from the Treasury or from the state, depending on your population size and kind of how that has been set up, as the Treasury guidance has told us. Monica, if we could go to the next slide, please. I don't know if there's a delay. I'm having internet issues, so it could just be a delay on my side. So if you notice on the left-hand side, there's a number of different programs underneath ARPA. So we're going to be talking specifically about the Fiscal Recovery Fund, or the FRF, or the SLFRF for State and Local Fiscal Recovery Fund. Again, that's the money that has come directly to you, either through the state or from the Treasury Department directly. And a part of that, if we go to the next slide, is going to be one of those 6 pillars of eligible expenses. The one we're focusing on today is that replacing public sector revenue loss. We're going to talk through the calculation provided by Treasury on how to calculate revenue loss based on some prior fiscal years to come up with what we're calling a counterfactual. And we'll get into that. But if you notice, there's 5 other categories that are eligible expenses. We're not going to be touching on those today. We have an overview webinar on Tuesday coming up at 10 a.m. that will cover a little more in depth of what qualifies as an eligible expense under each one of these categories, including the revenue loss, what we can use that money once we've calculated what that revenue loss number is, what we can use that money for. We'll touch on that a little bit today as well. But wanted to just say we're not ignoring the other 5. We're just really focusing on that bottom left revenue loss calculation. So jumping right into it, it is going to be a little bit heavy today on numbers and math. I will do my best to walk us through. We are developing some other tools that, based on the questions that have been asked of us thus far, we're going to start building out some additional tools that hopefully will be helpful, that we can provide so that you have an understanding of what to look for when you start to calculate your own revenue loss. So a couple of things that we're really focusing on is that revenue loss calculation methodology, identifying your base year revenues for the one of the first data points that we need, and then we'll talk a little bit about those eligible government services that can be covered with this revenue loss number. And so what do we mean when we're talking about these general rules of revenue loss? We're really looking at these are the guidelines on how to calculate what the numbers are going to be looking at. So not even before we look at numbers, but what numbers are we even going to pull from? We're going to look at either audited or numbers that you're going to be able to replicate in the case of an audit down the road. So if you don't have an audited financial statement, you need to be able to have some sort of documentation to identify what you've classified as a general revenue and what you haven't. Data could be cash accruals or a modified accrual basis. That's going to be up to you, but do maintain your consistency throughout the entire period of performance if you're calculating these revenue losses. We're going to want, Treasury would like the revenue calculated on an entity-wide basis. And what that means is if you have a hospital underneath you or any sort of other entities that fall, an airport, something like that, you're going to want to include those revenues as well. So for the county, for example, CCH, Cook County Health, falls underneath the county, and that would be considered part of their revenue loss calculations. The bottom one, we're going to be looking, it's a case-by-case basis on federal funds that are included in the revenue loss or in the general revenues bucket. One thing that is going to be called out is that CARES Act is not considered a general revenue, and we'll get to that in a minute. But really what the Treasury is trying to do with this revenue loss is understand that the pandemic hit our communities in a variety of ways, and one of the most prominent is that revenue loss. Like, we didn't see profits from our small businesses, from any of the organizations or institutions that generally generate those revenues, and so it's the Treasury's way of kind of acknowledging that and saying, yes, we're going to let you use the money that we've given you to cover this. However, we want you to calculate it in a certain way. And so the next slide really gives kind of an understanding of the 5 steps that we're going to be walking through, starting with determining those general revenues, calculating what we call a counterfactual revenue. We'll get to that in a little bit. And then what your actual revenue is going to be for that value, that data point from the past year, and then subtracting the two, which is my favorite and easiest step of the entire equation, and then what we report to the Treasury. So one piece of information, we covered this yesterday in the reporting webinar, is if anyone on the call is a metro city that has less than 250,000 in population and received more than $5 million in fiscal recovery funds, will need to submit an interim report at the end of August. And one of the data points, or I guess 5 of the data points on there, is calculating if you intend to or already have used some of your funding for this revenue loss category, you'll need to report those data points on how you calculated it. So there is a bit of a timely aspect in understanding kind of the components of the equation itself. So we'll jump right into step 1 and talk through what some general revenues are. You're allowed to include taxes, gross revenues, miscellaneous general revenues, things like parking, parking fees, tolls. That's all going to count as a general revenue. And the Treasury is really asking to look at the Bureau of Labor. Nope, got those confused. Really, they're trying to find some general revenues across all your revenue streams. Remember, this is on an entity-wide basis, and really just kind of going, maybe not line by line through your financial statements, but there are some big ticket items that are on your financial statements. And then the next slide really shows a good kind of example, going through an example revenue statement and just saying yes, no, yes, no. So this is going to be a fun exercise to talk through what's qualified and what's not qualified. So the museum grant would be considered an intergovernmental transfer from the state, and that's included. However, that CARES Act or the CRF money that we mentioned previously is not considered a general revenue. I know a lot of municipalities received money from the county in 2020. That's not going to be considered a general revenue when you're doing these calculations. The box on the far left really talks through some of what the ineligible revenue sources are. So things that were not to be considered. You'll see some examples in the red rows on the right. We don't want to do any utilities revenue. I know that gets a little bit tricky. It's going to be a case-by-case basis. So please bring those questions. We can talk through what that looks like. It's going to be any other kind of debt or sale. The Treasury really just doesn't want this money. If you remember from the overview, one of the things we can't use the FRF money for is for a rainy day fund or to pay down any debt. So really continuing that theme into the revenue loss calculation. So if you look, we have revenues, refunds aren't going to be included, neither are sales of investments. But all these other property taxes, the different kinds of taxes and interest would be considered an eligible revenue to be included. So once we've gone through and identified our eligible revenues, we'll start to look at the equation on calculating it. It's just kind of starting from the top. So we're going to be using throughout this entire presentation, calculating our revenue loss through the end of December 31st, 2020. So, the ARPA funds start March 3rd, 2021, but the first revenue loss is going to really look at revenue loss in the year 2020. So all of our kind of the values that I'll be talking through and the example equation that we'll walk through is calculating through December 31st, 2020. There will be a chance throughout the entire period of performance of the Fiscal Recovery Fund to recalculate. We presume Treasury is still coming out with additional guidance for fiscal recovery funds for 2021, 2022, 2023 as we go. But right now, today, we're just going to be looking at calculating that revenue loss for 20 through 2020. And we know a lot of people, their fiscal year doesn't end on the calendar year. The calculation does an adjustment so that it takes into account those offsets. So really just kind of walking through, we're going to have this counterfactual revenue, which we're going to calculate with our 2019 pre-COVID general revenue based on the revenues that we just identified as being acceptable. And we're going to multiply it by what we're calling this growth adjustment. If you notice, there's two options to that, and we'll talk through what both of those look like. One is the average annual revenue growth between 2017 and 2019. So you use the average growth between 2016, 2017, 2017, 2018, 2018, 2019. So you'll have 4 years, but 3 values, average them. That will give you one growth adjustment number, or the Treasury is saying, based on statistics, 4.1% is about an average for everyone. You get to choose between the higher of the two. So if your average revenue historical average is higher than 4.1%, then you'll be able to use that growth adjustment. If it's lower than 4.1%, you're able to bump up to that 4.1%. Once we've done all of that, we'll subtract our actual revenue through December 31st, 2020, and that's going to be the number that we call our revenue loss number, and that's the amount that we can apply towards those government services. So really looking into this the next slide really walks through some example values that we'll be using. So much of what I just talked through, it's kind of a more granular, less picturesque formula at the top. We'll be using for our base year revenue 25, these are in millions, but 2,500, it's easier for me to say. We've calculated, and we'll walk through how we found the calculation of our historical average growth to be 6.05% or that 4.1%. And in this example, we'll use November 30th as the fiscal year end. Therefore, there are 13 months from the end of the fiscal year prior to COVID, which is 2019, through the end of December 2020. After that, we're going to use 2,200 as our actual 2020 revenue. So kind of give some grounding around the numbers that we'll be using to calculate through this example. But looking at that first 4.1% and what it looks like as we're talking through it in the equation, you'll notice that we have our base year revenue. Monica, if you move to the next one, please. We have our base year revenue of that 2,500, calculating that 4.1% growth adjustment using 13 months over 12, because it's 13 months from the end of the fiscal year in 2019 through the end of calendar year 2020. Adding everything together gives us a counterfactual revenue, or what could have been our revenue values in 2020 as 2611. So just kind of walking through, we've calculated this number. So 2611 is based on what Treasury said we could use with that 4.1%. And then the next slide shows what's going to happen if we use the average calculated growth. So you'll notice we had revenues in 2016 of 2,100, 2017, 2,200, going through, and the average of those 3% changes is 6.05. So we're looking at a 4.1% growth adjustment or a 6.05% growth adjustment. Again, we'll use that base year revenue of 2,500. That number will stay the same. We'll use the value 13 for our N, which is the number of months from the end of the fiscal year in 2019 through the end of the calendar year 2020. Plugging all those numbers in will give us a revenue, a counterfactual revenue, or what could have been in 2020 of 2664. So now that we've done all of that really easy math, we'll kind of compare those two numbers, the 4.1% and the 6.05% against each other. Remember, we just walked through how each of those were calculated. You'll see our 2664 using that 6.05% growth rate is going to be higher than using the 4.1% growth rate. So we'll use that 2664 as our counterfactual revenue. Remember, Treasury said either use 4.1% or calculate your historical average to whatever that is. And if it's higher, you get to use your counterfactual growth adjustment to be that higher value. So we'll use 2664 as our counterfactual revenue for 2020. When we plug that into the easiest step of the equation, on the next slide, we'll have, 2,500 times our 6.05, which gives us that 2664. If you remember, we're using our general revenue for 2020 as that 2220 number, and the difference of those two is going to be 464. So what this means is that based on all of our other calculations, how we got to this number is we have 464, remember this is in millions, $464 million to be considered as our revenue loss for 2020 through December 2020. And that's the number that we're going to be able to apply towards government services. The next slide really just kind of shows it in another presentation, really. I'm kind of walking through the different steps. So you'll see the 2500s, the 2220s are the same for both. We calculate it back to 411 and then 464. And that 411 in the third column is what would happen if we had used the 4.1% growth adjustment, and then subtracted out our base or our actual revenues in 2020, which is that 2220, to give us 411, which is less than the 464. So we'll be going with that higher number. Once we have that, this is kind of talking through, this is a reporting slide talking through when we're going to have to report these data points to Treasury. So we aren't, right now we're still waiting for additional information on Treasury for future years. But this top kind of middle section talks through the 6 data points that you'll need to report to Treasury if you fall into that metro cities category, which is population less than 250,000, and you received more than $5 million in fiscal recovery funds. You are responsible for submitting an interim report due at the end of this month. And for that, you'll need to provide the number that you found for your base year general revenue, which is the one we're using, is 2,500. Your fiscal year end date, which will help us calculate that N value. For our example, it's November 30th, which would give us that N of 13. The growth adjustment used, that's either going to be your 4.1% or your calculated average historical percent growth. And then actual general revenue of 2020, that'll be a data point using the same guidelines and assumptions you use to calculate general revenue. And then your estimated revenue loss due to COVID as of December 31st, 2020. In our example, that was that 464 million. We understand that a lot of people haven't used any of their money. What Treasury said in this interim report is if you plan to or already have used any of your allocation towards this revenue loss data point or allocation bucket in order to use it for government services, you do need to provide the data points listed here. So even if you haven't done anything more than just calculate it, Treasury, and you fall into that metro cities category, Treasury asks that you report those 6 data values, and then the last one being a narrative about how you intend to use that towards government services. So we've talked a lot about what government services are. There's always going to be a what government services aren't. And if you remember, there's those 6 eligible expense categories that we can use our fiscal recovery funds for, 2 of which are around infrastructure, one being water and sewer, and the other broadband. And if you've heard us talk about them, there's very specific guardrails and guidelines on what you can use the ARPA or the FRF funds for in terms of those infrastructure projects. Eligible government services also include infrastructure. I know that word is on the slide. These are going to be more of your kind of general infrastructure. So while ARPA FRF is looking at the recovery and the rebuilding of your community, this government services category is really giving you the opportunity to kind of build from within. So if it's rehiring or health services, or you want to look at towards any sort of remediation or school or some sort of kind of internal things that you normally pay for in your community. If you want to do more roads, building out your building, kind of do a little bit more construction on that. This is that eligible government services category. Again, kind of our still no-nos, debt, short-term revenue, fees with any new debt. Really, the government hates when we pay down debt with their funding. And again, we can't put it into a rainy day fund. So I know that was a lot. I went fairly quickly. We tried to update the slides a little bit more to kind of talk through what each of the numbers meant. But that is the end of our presentation here. If you have any questions, I know I've seen a couple things on the chat pop up, so we will get to those. But if you're going back through this webinar later today, next week, before next Thursday, we do have a list of resources and there's a form you can click on. You can submit your questions. You can also use that friendly and familiar suburban COVID funding questions at Cook County email address. And we do include a list of links that might be relevant to any of the ARPA or FRF funding that we have, including the state's non-entitlement unit webpage and kind of how that money comes in and out. And I will give a plug for the, we have office hours tomorrow at 10 a.m. on this channel being in quotes. This is a Teams link. And we also have on Tuesday, Wednesday, Thursday, and again, office hours next Friday. So we are continuing our weekly schedule and roadshow, kind of talking through. We'll do the overview again on Tuesday. We'll talk to that interim report for those metro cities. And then again, we will have this webinar on revenue replacement next week if you'd like to come back or just ask the questions and hear us walk back through that equation. So with that, I will pause and open the floor for any questions.
So Natalie, it looks like there are a few questions in the chat around themes, and I want to just caveat or put a little asterisk by the Q&A session. We'll do our best to answer very specific questions based on the guidelines as we understand it right now, in terms of eligibility of what's eligible for under government services, or the nuances of what can be done in the calculation. We are sort of learning and absorbing the guidance along with all of you in real time. So if we can't provide specific direct answers today, just know that we'll go back and do what additional research we can to address your questions either next week in a follow-up webinar or offline with you directly. So that said, we'll just tee up the questions in the chat. Natalie, I'll just tee them up for you. Christy had a question around, can you repeat the statement about the upcoming October deadline for metro cities only?
Sure, and that's going to be an August deadline. It's the end of August. It's for the metro cities, and it will be, if we go to slide 19, it'll talk through one piece of that. The interim report is required only for those metro cities with populations under 250,000 and received more than $5 million in fiscal recovery funds. And one of the data pieces in that report is going to be if you have or plan to use any portion of your allocation towards this revenue loss, you need to provide information for each of those 6 data points in the middle of the screen, the last one being a narrative about how you intend to use those replacement funds for government services. The other pieces of the interim report are going to be just a report out to the Treasury expenditure categories on how much has been obligated or spent through July 31st. So I know a number of communities didn't receive or hadn't spent anything on their fiscal recovery funds before July 31st. So those numbers would all be zero. It's our understanding we'll still need to submit that that report with zeros in it. But we would need to, if you intend to use the revenue loss, you would need to add those additional data points to it as well. And that's August 31st. And there is a project and expenditure report due at the end of October. We're not talking about that one as much just due to the timing, but that's going to look at projects and expenditures. So that's going to be for everyone. NEUs, metro cities, the county, the city. That's October 31st, but this interim report is only the metro cities, and it is due August 31st.
Great. Thanks, Natalie. from a process perspective, I see a couple of process-oriented questions in the chat. And the question around, will these slides be available for download? Yes, the slides are, and as we update them, they will continue to be available on the county's website. And then in terms of office hours, those are intended to be interactive to address your questions one-on-one. I think we'll take questions and address as many of them as we can one-on-one on a first come first serve basis on Friday, as Natalie said, same time, same channel. So kind of moving through the chat questions, I know there is an ongoing dialogue between a number of folks and our other team member, Alex, who I neglected to introduce at the beginning, but sounds like there's some police and fire pension fund and stormwater fund questions in the chat that I believe Alex is addressing. There are a couple of questions around, Natalie, can you clarify the purpose of the 13/12 ratio in this specific calculation?
Sure. So in our calculation, if we go back to the very beginning, on slide 11, when we talk through, or maybe slide 12 would be a better kind of example of what we're looking at. So one of the pieces of the calculation is that N number, which is the number of months since the end of your base year to the calculation date. The calculation date is December 31st, 2020. The end of, in our example here, the end of the full fiscal year ahead of that we're using as our base year is November 30th, 2019. And so that 13 comes from how many months is it from November 30th, 2019 to the end of December 2020. And that's going to be 13 months. So you'll calculate it from the end of whatever your base year is. If it's October, that number is going to be 14 because we're looking at a full fiscal year pre-COVID. And so COVID was officially declared in January of 2020. So we'd want to do whatever full fiscal year comes before that date.
Thanks, Natalie. I see another question in the chat around from Ben that I don't think was answered. I'm trying to keep up here. Is Rebuild Illinois money received in 2020 considered in the calculation? And Ben, we may need you to, Natalie, I don't know if you can address that if we need more information from Ben on that.
I don't know all of the details around Rebuild Illinois, so I would need a couple additional details.
Yeah, this is Ben.
Hey, Ben.
Hi, how are you? Yes, the city has been receiving funds from the state of Illinois. Previously, the state of Illinois issued a bond for the purpose of helping municipalities rebuild their, obviously rebuild their roads. Question is that those funds were received in 2020. And for purposes of the calculation, should those funds received by the state of Illinois be included in the calculation? We didn't receive any funds in that character in prior years. So is that eliminated from the calculation, or should it be put into 2020?
It's a good question. It sounds relevant to a number of parties. The Treasury FAQs, and I'm just going to read it directly, says general revenue, which is going to be an eligible revenue, also includes intergovernmental transfers between state and local governments, but excludes intergovernmental transfers from the federal government, including federal transfers made via a state to a locality for the CARES Act or the fiscal recovery funds. So based on that statement and what your explanation of it, it sounds like since it's coming from the state, it would be considered, it could be considered a general revenue. I am not a tax expert, I will say that, so it might be a good question for maybe your tax specialist or someone who's a little more familiar with how your kind of community is establishing what an intergovernmental transfer is. But based on just that quick explanation and the Treasury categories, it does sound like it would be an eligible general revenue.
Okay. Okay. Thank you so much. Appreciate it.
You're welcome.
I see someone else has their hand up. Kent, did you have a question relative to that topic or another question?
I have another question. Can you hear me?
Yes.
It was actually a question that Chris Mirabelli asked. So when you levy property taxes as a municipality, you can do it for different kinds of levies. And if you were contributing towards a police or fire pension fund, you can do that either through your general corporate levy, or you could do it directly to the police or fire pension levies. And if you do the police or fire pension levies, it goes directly to those pensions. Whereas if you do it through the corporate levy and you intend that for the police and fire pension, it flows through your general fund and then you make the contribution. Does one of those count as revenue and one does not, or do they both count as revenue? So does the police and fire pension levies that the municipality levies that goes directly into the pension fund and doesn't pass the general fund, does that count as revenue? It does, by the way, for accounting purposes, it pretends like it goes to the general fund, even though it doesn't.
Ooh, that's a meaty one.
Yeah. That might be one, Kent, that we need to think about and get back to you. Yeah.
Yes, please. I'm trying to wrap my head around it. I know one thing to be careful of is not to double count any of our revenues. So it sounds like there's a potential that this could be counted doubly, and we don't want to do that when we're calculating it. But as to kind of which one or either, I think I'd need to think it through maybe a little bit more with the team.
I will put my email address in the chat, and if you reach out to me, I'll try to write that up so you guys can have time to think about it.
That would be perfect. Thank you.
Okay, well, you stumped us. Good job. Natalie, Janet has a question. When you refer to revenue, quote unquote, collected, are you referring to receipt on a cash basis or the modified accrual basis, which would include amounts receivable?
Either. As long as you're consistent throughout the calculation across the years, that's one of the leeways that Treasury has, that you can either do it on a cash basis, an accrual basis, or a modified accrual basis. So that would be your choice. I would just maintain consistency in your calculations when you do your base year and then your kind of what your actual general revenue is. I would use the same system.
Thanks, Natalie. Let's see. Lanya has a question. Please address calculations for fiscal year end at April 30th. Lanya, I would say that kind of gets to the question that Natalie addressed earlier, just the 13, the number 13 over 12 calculation, so we'd be, hopefully that answered your question, but if not, if you wanted to walk through your entity's specific numbers, happy to do that with you offline if you wanted to join the office hours tomorrow. In the meantime, Rashid asks a question: would a one-time sale of a building be included in determining the actual revenue as of December 31st, 2020?
I would like to say yes, but I'm not 100% sure on that. But I believe so. Team, I mean, I don't see anything that specifically says not. Oh, nope, sale of property is explicitly called out as an eligible example. That would fall under yes. So yes, I see it now in my notes.
Yep, that was my initial reaction as well, Natalie. Thank you for confirming. Scrolling through some of the other questions in the chat. Would motor fuel tax monies be included as general revenue? I think Alex has addressed that. MFTs are eligible.
If MFT is motor fuel tax, then yes, it is eligible.
How about property taxes for TIF funds? And Alex, I think you answered that, that yes, that would be considered an intergovernmental revenue from the state. So please correct me if I've misstated.
So Trina, just to jump in there, I think the question on MFTs, on motor fuel taxes from the state, I was saying was eligible as an intergovernmental transfer. I think the question on property taxes from TIFs also eligible, specifically called out in the guidance as well.
Thanks, Alex. Let's see. With lost monies, Chris has a question around lost monies for debt services levies be included as lost revenues, since those monies would have to be made up by the general fund so that the municipality doesn't default. Another good question. Chris, we may need to think about that one and add it to our to be researched question. That's a pretty dense question.
So just a point to that, Chris, we're not including kind of additional lost revenues. We're calculating our lost revenue based on what our actual general revenues were, and then which is our base year. Our counterfactual was what they could have been in 2020, and then our actual 2020 revenues. So really our calculations just looking at revenues and not kind of including those lost revenues. But again, we'd have to go back and maybe think that one a little bit through as well.
We're taking notes, and we'll definitely get back. I think Natalie may have mentioned when she was kind of talking through the technical assistance, the webinar schedule. As part of that, we do continue to add to and update a set of frequently asked questions reference list for ourselves as well as for this group. And we will keep that up to date in real time. That is based largely on the questions that you all are posing to us through the inbox that you may be sending us, and largely in these webinars. So keep them coming. And particularly the ones that are applicable to multiples of you, as a number of you have pointed out here in the chat today. So if you miss them in the webinars, then you can always go to the FAQs that we will keep updated. I think finally, Christy has a question around, can you talk a bit about how to report property taxes?
We would include property taxes as an eligible general revenue. I'm not sure. Maybe I need a little bit more on the question to really answer properly.
So Christy says, my question about property taxes is due to collection rates. Collection rates. Christy, we might just need a little bit, even a little bit more on that.
So can you hear me now? I'm sorry.
Yes, we can.
Myself off mute. So in 2021, there's been a lot, there'll be a delay in collection. So that's kind of skewing what may happen in any fiscal year for municipalities because of COVID. But in general, again, this kind of question comes to the receivable or the expectation of what you're going to be getting, which your levy is based on, versus what you actually collect in property tax. So wondering, do we break it down just so that it is actually what comes into the municipality that's been paid by taxpayers?
You're talking about for fiscal year 20?
Or even if we're using 2019 as the base? This is in light of the fact that some taxpayers default on payment.
Right. My gut says we might need to think this one through and kind of talk it out as a team. My gut says that as long as you're consistent in how you're calculating it for each of your revenue loss calculations, then you would be, as long as you consistently do that. So if you do that accrual kind of with the levy and the anticipation, or if you go with an actual cash basis on what actually came in, those would be eligible to be included, which I think was your question. So the reason, Treasury understands is why they kind of give that 4.1% or your calculated historical average. They understand the pandemic's going to hit different communities, not only in different ways, but at different times, which is why you can calculate this revenue each of the years of the award as well. So my gut says yes on that. I don't know, Alex or Trina, do you have any other thoughts or takes?
Can I ask one follow-up question about that? So if we're looking at the 3-year average, do we need to be consistent with either the accrual or cash basis through that exercise, or could each year be calculated different for a sum?
For ease and simplicity, the Treasury doesn't state explicitly, but I would just say be whatever you choose, just be consistent in case you have to recreate those data points. So if the whole team wins the lottery and leaves, someone doesn't have to go back and kind of understand which year was accrual, which year was cash, just kind of those consistent values. So I'm not proposing we game the system, but just with some consistency in how those general revenues are calculated.
Okay, thank you.
And Natalie, I don't have anything else to add. I think we need to go back and think about your question a little more deeply, Christy. Thanks for raising it. Rashid asks, should sales tax rebates that are typically shown as a reduction to sales tax revenue be included when determining the change in revenue from year to year?
I believe it would be excluded. The Treasury calls out refunds or other correcting transactions as not considered a general revenue line. But I would maybe need to read the question again and as well.
Yeah, should sales tax rebates that are typically shown as a reduction to sales tax revenue be included when determining the change in revenue from year to year? I would tend to agree with you, Natalie. I think part of it is just how those sales tax rebates generally are sort of quote unquote normally treated. Would be relevant to that question.
Yes, it sounds like it's a bit like a refund, which are called out as not eligible general revenues.
Kent asks, are foreign fire insurance revenues included? These are usually special revenue funds, but administered by employees and not the elected municipal officials. In other words, a separate legal authority by state statute.
Is this going to be kind of I don't want to call it an auxiliary because I know that's a different word in the auditing and financial world, but would these be considered as part of your kind of overall financial statements, Kent? Because what it sounds like, and I'll go ahead.
It's weird because they're kind of like agency funds or something. You would think that they wouldn't be part of the main financial statements because the local authorities don't have any control over that money, but because it usually benefits the municipality in some way, they're usually a special revenue fund. So it's not usually budgeted because again, they don't have any control over that money, but it's special revenue. So it is part of the regular financial statements. It's not like the police and fire pension funds, which are sort of on the outside of the statements.
Right. The only reason I ask is it sounds like this might be kind of falling into that entity-wide basis. So kind of looking at your government, your kind of municipality as a whole, and this would be one of the entities underneath it.
Yes, I agree.
Okay. Well, that's kind of
I'd assume it was included because it's a special revenue fund and it's part of the entity. It just the control doesn't rest like it usually does. Same thing sometimes happen with police have some seizure type funds, and sometimes those are budgeted by the municipalities, and sometimes the police department say that you really have no control over it, and they sort of keep it to themselves and don't budget it. The same sort of thing happens sometimes with those special revenue funds. I would assume all of those would be included, whether they're budgeted or the expenses are approved by the board or not.
I believe, at first blush, yes, I would say those would be included as well. And we might need to dig a little bit deeper, add that to our list of research topics for the next week to kind of dig a little bit deeper into what each of these kind of special purpose funds and the different categories they are, and how it relates to the entity as a whole.
So Kent, we'll add that to our list. Continuing to scroll through questions, Joe, in answer to your request for the PowerPoint, as a reminder, all of the with any updates that we make as we update our research in response to your questions, or as Treasury updates the eligibility guidance or calculation guidance, these will all be posted to the county's webpage. And Ted Nelson from Cook County has put in the chat, I think a couple of times now, the link to the page where you can find this and other of the webinar presentations. So hopefully that makes it easy for you. I believe Alex has answered Kate's questions about CDBG distributions from the federal government, noting that CDBG distributions would be considered a federal program and therefore would be excluded from your revenues because it is an intergovernmental transfer from a federal program. And I think I have reached the end of the chat questions. We have a few minutes left in the hour. If there are any additional questions or follow-up, or if I missed any of the questions in the chat, please go ahead and unmute yourself and let us know. No last takers. Okay. So with that, if there aren't any additional questions, want to again thank you all for these questions. And it, as Natalie and I have mentioned at the beginning, it's very helpful for us to get your questions, and helps us all to understand this very important set of calculations and eligibility criteria more deeply. So appreciate your engagement and your questions. We will be following up on a number of the questions that we weren't able to answer today, and we'll be addressing them in the future through future webinars and or through the FAQs. Would also like to encourage any of you who do have additional questions on this or other ARPA topics to attend the office hours tomorrow. Again, as we said, same time, same channel. So with that, we will give you 6 minutes back into your day and wish you a happy Thursday. Thanks all for joining.